Thanks, Rich. Again, my name is Mark Nelson. I work with Kansas Farm Bureau. And typically what I do is I kind of run through some pre-harvest plans, and I'll do that again today. But I guess, gosh, first thing, has Kansas wheat ever been this bad? Depends on where you're at. I'm looking out my window today and it's raining. We've had about 2/3 of an inch so far here in Manhattan. I think the wheat in this area isn't too bad. So we've got some places in Kansas that's got some good wheat. We've got some places that the wheat's already tore up, right? And people are deciding what to do. So this has been a real mixed bag. We're starting to get some rain, so conditions will get better. But I've got it circled there. That's where we are in 2023 as far as the percent of the Kansas crop that's in good to excellent. And have we ever been this bad? Well, the short answer is, I guess, yeah. In 1989, we were getting ratings even worse. But you got to go a long ways to be. Now, we had 2 or 3 years that we were like this, but those are pretty nasty years, and this is another one. Okay, so what do I want to do today? I want to review our pre-harvest plans. And again, we as a winning the game team kind of put together example pre-harvest plans for feed grains, soybeans, and wheat. And we put those out early, and then we try to run through any given year and see how these plans, these ideas that we'd have would play out. And so that's what I'll do first. And then I want to talk a little bit about post-harvest wheat marketing, because we're getting very close the next month. By the time we have the next one of these webinars, people will already start be cutting. And so we need to start thinking about, if I do have a crop I'm cutting, what am I going to do with that? And we'll talk about that a little bit. What are some of the things? What's the market looking like for that? And then I'll turn things over to Dan, and you get some great information from him. So when we talk about these pre-harvest marketing plan outlines, basically we run through 7 principles, right? We talk first, we want people to determine the number of bushels that they want in that plan. Right? It could be all of your expected production. It could be your APH production. It could be 1/3 of expected production. But what we want producers to do is to say, how many bushels do I want to put into my pre-harvest plan? How many bushels do I want to price? And then of those bushels, then number 2, how many incremental sales do I want to make? And we start breaking this thing down. 2 other or key ones there is number 3 and 4, price targets. We want you to set some targets on good prices that you would like to take action. And we say, set those at incrementally greater levels. And that way we're building a plan that in a rising market will allow us to have the patience to kind of hang on and wait for that market to come to us. Very similar to last year, right? We had a very strong year, right? Prices took off like crazy. In fact, our plan and our targets didn't even keep up with it. But we want those incrementally higher price targets so that you can sell into those. And so you don't sell it all too early. The other one, decision dates, comes in years like this. These are dates that you're going to take action regardless of price, right? So if my price target, I don't hit that, we don't get that kind of a price rise, we're going to take action no matter what at our price targets. Now, those outlines that we create, I often go through, they're in the back of my presentation. I'm not even going to go through them, but they are in the handout. I'm going to kind of jump in and just take a look at where we are progressing. Other principles, we don't want people to price below their estimated cost of production. In a year like this with wheat, that gets tough, right? My yields are decreasing potentially. Now, again, here on the east part of the state, northeast especially, hey, we might be seeing average. I know some folks may even see above average yields this year. But for many folks, we're seeing significantly lower than expected yields. And so that cost of production goes up. How much? These are things you need to be running that pencil on. But we don't want you pricing pre-harvest below your cost. Number 6, catch up. If we pass the decision date because prices were too low, and last month we had that happening, right? Prices were so low. In my estimate, we weren't covering our cost of production, so we said we're not going to price. But if we do see a price rally later, and we've seen prices jump up in some of these markets here in the last week or two, we want you to make some catch-up sales. Pricing tools, that's the 7th part, the 7th key principle. Use what you're comfortable using, right? If it's just for cash contracting, fine. But options, futures are really good tools. We'd like people to take a look and learn as much as you can about them. And if you're comfortable using them, do that. With some of these more advanced strategies, and I'll kind of go through one today, work with your broker on those. And I'm going to take my picture off just because that way I see the screen better. There we go. Here's our sample 2023 pre-harvest feed grain plan. So basically our corn, our milo, and this is really more for the corn. I've got the December corn futures up there right now. Our first, and here's a great example. On January 1, when we started our plan, we were at 607. That was the close. We got up there once, didn't close above it, but we've never seen prices in December futures get that to that level again. So that's where our decision dates really come in handy because it's making us take action. Our first decision date was March 15th. Prices at that time were what I thought would be below our cost, so we didn't price. We got up to 570. That for at least parts of Kansas, at least 2/3 of Kansas, we were actually in a position to cover our cost of production. So we priced 20% on March 29th on that rally. We got back up to that area, 570 again on April 18th. We priced our second. So kind of, where are we at right now? We're 40% priced. Our goal is 60%. So we've got catch-up sales that we need to make. But at this point, where prices are, and again, we're rallying a little bit today. And this chart is as of last Friday. We don't really want to price until we get up to that 565 to 570. I think at that point, given current basis levels, for many parts of the state, you would be able to cover your cost of production. So again, we want to see a better rally. We're not going to price at these levels. Sample pre-harvest plan on the soybean side. We're kind of following the plan. Again, January 1, prices were at $13.97. We got up above that, so we were able to price our first increment February 21st when futures hit $13.99. We were covering our cost of production. Our price date was hitting it. We priced it. We went along. Our second decision date was April 15th. Futures hit 13.01. We went ahead and priced it. Downtrending market, we don't like that, but we went ahead and did it, right? Because we're covering our cost of production. Same thing on May 8th. We saw prices kind of bounce back up to that 1280. At that level, we feel like, yeah, we're for most locations or for 2/3 of the locations that I'm tracking, we were able to cover our costs, so we went ahead and did that. So we're 60% priced in that plan that we developed back in January. Essentially, we're on target. Our price target is $15.50. Do I think we're going to get it? Probably not. We'd like to price at $13.20 if we can get a rally up to that level. For sure, we're covering our costs. The question is should we accept if we hit that $12.70, $12.85? Again, as I follow basis, we're covering our costs probably, if we believe our costs are roughly $12 a bushel, we would be covering them for most places in Kansas if we can get it back up to that $12.70, that $12.80 area. So we sure would like to see a rally. We're not quite there. On the wheat side, tougher, right? Back in October 1, when we would have started that plan, July futures were $9.60. Very quickly, we saw prices rally there, within a week. So we priced our first increment. Everything was going great. Haven't seen prices that high since. And for much of this year, we've been seeing opportunities that I would argue were probably below our estimated cost of production. So we weren't pricing. We did a second increment today, right? The U.S. report came out last Friday. Dan will go into that in more depth, but we've seen prices rallying up. So we made a catch-up sale, another increase or an increment of 20% today. We'll see where things go. If we can, because we need some catch-up sales to be done, right? We're 47% priced. We'd like to be 80% priced. Obviously, we're a long ways from that. Our price target in that initial plan was $12. Again, I don't think we're going to hit that. And at this point, I wouldn't want to take any more action until 9:30. Again, earlier this summer, we kind of we adjusted our cost of production because of lower expected yields. We'd like to see a cash price of $9. We did go ahead and price it $8.97 just as a catch up, but we don't want to do any more until 9:30. So again, we're kind of behind, but this is where we're just following that plan that says don't price below your cost of production. But for some folks, you probably are covering your costs, and I'd say be more aggressive than we're showing here in this plan. As we pivot away from pre-harvest plans and start thinking about post-harvest, right? Because within a month, we'll be cutting wheat here in Kansas, if you've got it yet. And so we're going to have that don't store decision. Now, what this chart I've got right here is a 15-year Kansas seasonal wheat index. It's not futures. This is the NASS data, the average monthly price, but I've turned it into an index. And as you look at that thing, we do see prices rally, right? From that October low up into that February, April period, we do see prices. The question is, do prices rally enough to cover my cost? And when you're making that don't store decision, here's a couple of things we want to look at. Is there futures carry? And Dan always covers this, but the short answer on wheat, no, right? There is no carry in the futures market right now. Is there potential for basis appreciation? We'll look at that a little bit closer. I would argue no. So for the first two questions, the answers are no. It makes storage a tough thing. Third thing is take a look at your storage costs. I've got a slide on that. I'm not going to cover it, but there's a great publication that came out from K-State. I would encourage you to look at that, but you definitely want to get a handle on what your storage costs are. What I did was I kind of looked at it this way. Now, this is, again, that 15-year. Now, I've converted now. It's just these are the average prices. So for the month of July, $5.54. That's the 15-year average state, or the average price of wheat in Kansas, according to NASS. Okay, $5.54. And so then we chart that through there. What we see, again, a lot of times on average, we'll see prices get up there about to $6.10 on average. So we see a pretty good price rally. Now, again, looking at what our costs of production are, I just said, let's say it's in an elevator and they're charging me 3 cents. Again, this is sort of examining the past. And if I had 3.5% interest, that red line would represent what price I would need. Okay. Again, so for much of the fall, we're really not covering. But finally, February, March, April, May, if we hang on to that wheat that long, if we're getting charged 3 cents a month storage and then have 3.5% interest, we're covering it. Interest rates are a little bit higher now. If we're looking at 7% interest, the value of that dollar, it's a little tougher. Yeah, Feb, March, you're covering it, but it gets a little tougher. That's why, in the long run, I'm not a big fan of hanging on to my wheat in the bin, to be honest. Corn looks a little different. Soybeans a little different. Wheat's a tough one. Yes, I'm getting a better price, but am I really covering my costs? And so again, you really need to run the math on that. I'd be concerned we're not going to see that. What are my alternatives? Okay, well, we can store the grain and sell futures. And again, that would be that classic storage hedge, right? Put the grain in storage. I sell a deferred futures contract. I'm going to make money on basis appreciation. And that's what I'm going to make money on, is my basis appreciation. Again, I don't think we're going to see that this year. We can store the grain unhedged. Now, again, I think maybe a lot of people do that. I don't recommend it, but it does pay sometimes. We can sell the grain at harvest. And, we're at $8.98 if we're looking at, say, Salina, new crop bids. It's not a bad price. We can sell the grain and buy a call option. That's kind of that classic minimum price contract. You can do it yourself, right? Sell the grain, just be done with it, work with a broker and buy a call option. A lot of elevators might be more than willing to work with you also. They would call it a minimum price. You deliver the grain. Basically, they'll give you that current price and they'll go out and buy that call option for you and just take that off of the price they pay you. Essentially the same thing. You might want to run the math to see which one's more profitable, which way is a better way to go. Would you rather work with your broker or would you rather work with your local elevator on that? A lot of them will do that for you. You can also sell the grain, buy a call option, again, that classic minimum price, but then turn around and sell an out-of-the-money call. So again, one at a higher level. That's essentially a spread on your options. And so as prices rise, the value of those calls will increase. And once you pass the level of that out-of-the-money call, then it starts costing you money. And so what you're trying to do is create a window of where it's actually better, and you've increased your minimum price by doing that. Again, definitely, I'm not saying you should do that. And if you are doing it, I definitely want to work closely with your broker, because when you sell an out of the money call, you're taking the same risk that you would be under if you were selling futures. And so you need to be prepared, and you work with your broker on that. So let's run the math. Again, these are not recommendations or advice. I just kind of want to run through the math. So essentially, I've got 5 options. A, sell the grain at harvest. B, sell the grain and buy a call. C, sell the grain and put on what I call a bull call spread. D is a storage hedge. And then E, not showing it right now, would be put it in the bin and just hang on to it. Store it unhedged. Okay, if we sell the grain, again, this is a Salina, Kansas example. So right now, new crop bids are $8.98. July futures at about 10 o'clock this morning when I was looking at things were right around $8.98 because they have a zero basis there in Salina right now. I looked at a March futures. March futures were trading at that time for $8.52. So I looked at an at-the-money strike on that column B of $8.50. And again, that's the same one I buy on that option C. I buy an $8.50 call, but I would sell an out-of-the-money call a $9.50. So again, $1 higher. And I'm going to get, it was worth 41 cents at that time. So now I have a minimum price. If I sell the grain of $8.98, done with everything, I'm done, sold it. Sell the grain and buy a call, I've got a minimum cost or a minimum price of $8.28. And if I sell the grain and put that bull call spread on, I've got a minimum price of $8.61 because I was able to sell a call and that offset what I had to pay for the other one. If I were to put on a storage hedge, which means I sell March futures, which are trading $8.52, you run that hedge, you're locking in an $8.16 price. Doesn't look very profitable. So again, and why is it not? Well, okay, I guess I need to take a step back. This is the harvest time example. I'm using today's prices. So you'll need to redo this as you actually are ready to make that decision, trying to set the stage for what you'll be looking at in a month. Only work with tools you're comfortable with and work with your broker when using these more advanced things like buying that call, or C, definitely the bull call spread. At 46 cents, that's $8.52 March futures minus what the current cash price is available in Salina. So we've got a positive basis. Typically, a storage hedge is only going to work when we have a negative basis on those deferreds. So again, I think it's pretty easy to say, I don't want to do a storage hedge this year. It's not going to work. I can't wait to hear what Dan thinks. I think one of the questions of people when they registered was, what do we think about basis appreciation? I don't think we're going to see much. Because again, if you look at the deferreds, right, 8.52 futures, we're already seeing a 46-cent positive basis. Kind of going back, I want to say, let's see here, what are my numbers? 2023, if we look at, and again, I'm kind of looking at this thing saying I want to get out of all these positions in about mid to early. I'm looking at February 12th to be exact. I'm just kind of running the numbers for that, okay? Basis at that time in 2023 was 15 cents under in Salina. In 2022, it was 5 cents under. If I look at the 3-year average basis, it's 7.5 cents under. I would more guess that we're going to see, and I'm using a 0 expected basis. So again, historically a strong basis, but again, not near as strong as the 46 cents that we're currently seeing. Okay. So that's kind of where we're setting the stage. What happens if futures go down, right? March futures are right now 8.52. What if they fall to 7.52? What if we just, all the uncertainty gets kind of fixed? We're able to, maybe prices go down. Where are we at? Well, if you did nothing at option A, you sold the grain, you got your 8.98. Doesn't look too bad. Both of the options, sell the grain and buy the call, you're at that minimum level, 8.28, 8.68, because your options are going to expire worthless. And so you just got to keep your 41 cents. You have a minimum price of 8.61. The storage hedge got you to 8.16, but that's better than none of these things. So again, you sure don't want to do this. Storing it unhedged, 7.16. Storing unhedged, is the riskiest thing you could do. It will give you the highest high, but also the lowest lows. When prices decline, each of the option-based alternatives are going to result in their minimum price. We need prices to rally to make those option things work. So what if we see prices go up $1, right? March futures today are 8.52. What if they would go up to 9.52? Well, again, if I sold the grain at harvest, I'm at that 8.98. My option, B here, that option just gained $1. So now I'm getting 9.30 on that minimum price. Sell the grain, buy a call. Sell the grain, buy a call, and sell, right, that out of the money 9.50 call. I'm still making money on that, and I'm actually doing better yet. Storing it unhedged, I'm at 9.16. So I did better. But again, both of these sell the grain, buy a call options look better. At that point, I think I threw in there another sheet that looks at what if prices go up $2. We won't go through that. With this, I want to thank everybody for being on today, and I'm going to turn this thing over to Dan.
Mark, I appreciate your comments, and thank you everybody that's on here that's tied in with this. Mark, I'm going to go through both the current forward contract bids here down in a few slides, and also some scenarios to consider over the summer. Some of them having to do with USDA adjustments lower in production and how prices would respond. So when we get to those, don't hesitate to hop in and see. You know, they'll be probability weighted, but don't hesitate to hop in and voice your thoughts on whether that would trigger some of the pre-harvest sales issues that we're talking about. So I appreciate the chance to speak with you. Okay, let's see here. Right. Well, I think the biggest story for us right now, and actually in the U.S., is the rain. We've had look at U.S. precipitation the last 14 days, and you can see some of the areas in the northern plains that have caught quite a bit of moisture. You can see the scale on the right-hand side, up to 2 inches, some up to 4 and 5 inches. So we're hearing reports of delayed planting in the northern plains, and when you look at precipitation departure from normal, you can surely see those, again, the darker purplish side of things, and 200 and 300% of regular moisture. Now, I think some of that is reaching down into parts of western Kansas, but then the farther south you go, generally you're on the drier side. So we just have a continued variation of where we're at. If we pulled up this chart, particularly for the northern plains, to look at where the Dakotas were last year, but probably some similarities. So at least that gives us a point to consider with regard to some of the same dynamics that hit us last year in the market. If there's delayed plantings, we get close to insurance planting dates. What does that do for acreage for corn? Very, very likely for corn acres, be the first one up that you'd see affected. Could decrease corn acres some in the U.S. That 1 or 2 million. I've seen preliminary thoughts. First thought would be, well, gosh, we'd send acres over into soybeans. Well, that if that occurs, if they're able to get the crop in, get those acres in, then you're up in soybean acres. So we've got something to watch here in coming days. Of course, we've got with our moisture that we've had of late, you see the short-term and long-term objective drought blend tools that are put out, and still some dry areas, parts of Nebraska, parts of Kansas for sure, Missouri, but in the short run, we've increased some in western Kansas in particular for moisture, but still in the long term, still in drought. So what's that tell me? It says that we get the crops in, we'll need rain to keep coming, or because in a good number of these areas, there's still not deep subsoil moisture that reserves that have been replenished to the degree we can say we don't have drought problems. Of course, some of these areas got several inches of rain of late, so hopefully, and nobody's begrudging the rainfall that we just got. And you can still see some of the areas around the world, around the globe, the major crop production areas, and how they're affected by moisture. Here of late, I think you stand back, you look at the overall picture that I think affects the narrative view of the grain markets, that i.e. we're moving out of La Nina into an El Nino, and about the time frame May heading into June, et cetera, where that's expected to come about. If anything, though, probably more confidence amongst climatologists as to where this would go next year than this year. Still a little bit murky, but I think that general idea has affected the narrative of the markets, and giving them all that much more willingness to bid conservatively. Now, and here, Mark, I'd like you to kind of scrutinize bids. These came from this morning, looking at forward contract bids. Try to watch these particular locations, not one elevator necessarily, but the highest ones in probably a 30-40 mile radius. Highest bids, you see the spot bids, and then we're really looking at the forward contract bids. Again, you see out in the west, strong basis course in Garden City, 581, 525 in Colby, 515 in Hutchinson, and then again, $5 Salina, Topeka 485, 46 Columbus. Mark, you look at those. How far short in these areas are we from pricing given these forward bids for corn?
On our plan, where we said, maybe our estimated cost of production, and I don't know if really anybody is thinking that they're going to see yet on, say, corn, because we just getting it planted. We're using basically a 550. So, 550 cost of production. So again, you look at that, Columbus, we're not quite covering it yet, right? If that's your average cost of production. Again, the one I'm throwing in there always in our plan is really sort of a combination of all those 7 areas that you guys put together. So y'all need to look at your own, regionally. Mine's a composite for the state. But we were using 550. So, some are covering it, some aren't.
Let's take a look at grain sorghum bids. You do see some bids, and some, Garden City 506 for new crop bid, Salina 5. Generally, I know we'd put a feed grain number up there in general. I think you were talking 550 for corn. Is that 525 thereabouts, $5 for grain sorghum?
That composite would be gave us a 486.
Right.
It's break even.
Okay, so we're at, and for most of these locations, we're at or a little better than break even. Soybeans, I saw your plan as that thing was working its way around, and that 1301 that was a disappointment at the time, looks golden right now. that you'd priced at, but then again, that's why we have these plans. Look at those prices. How are we at with regard to break evens for new crop?
Again, the composite cost of production for the state of Kansas came out around 12. And again, I just want to put a caveat with that. We always get the average, but then we try to put a bit of an increment, right? Sort of a margin in there of anywhere from
profitability
to 50 cents. So we went with a nice round number of $12. And so at this point, everybody's blown.
Right. And then the one that we're looking at the price side, there's the production aspect of whether you have the bushels or not. But without question, we try to follow these every week on the grain markets, and we jumped up about $1 or so in terms of both the cash markets and forward bids. Yet we had a pretty healthy cost of production too, particularly if you have fallow involved as you go west. What do you think of these, Mark?
Yeah, our the composite that we came up originally was $8 again for that composite estimated cost. And then I think our very first webinar kind of went through that scenario of, okay, what if we have, you're thinking you're going to see like say 15 to 20% lower yields, and there's a lot of people. Not that far away from Manhattan that are looking at half, right? So anyway, we kind of adjusted our cost down or up to say $9. And so if that's the price, your cost of production, you're not covering it. If you're looking at 25 bushel per acre wheat, you're probably not covering it at these costs. But again, not everybody's there, right? I'm going to argue that probably people here in Riley County are looking at average yields, and so and the lower costs, and so these prices probably would cover.
Yeah, it's a bushel issue, isn't it?
You bet. That's the hard part on the wheat.
Yeah, just take note on that very bottom line. Soybean versus a new crop, soybean versus corn price ratio. Generally, nowadays we look at about 2.3. And we're looking at forward contract bids. 2.3 is a neutral number. So if you're above 2.3, you'd favor soybeans. If you're below 2.3, you'd favor corn. And it's interesting. You go out west, definitely favors corn. Topeka and Columbus definitely favors soybeans and somewhat that way, and right on around Salina Hutchinson. So it just interesting to follow that and see what the trends are. Okay, excuse me here. Okay, let's take a look at feed grain markets. Try to give you my best thoughts on where the markets are going and what the trends are and things to consider going forward. And again, Mark, just invite your thoughts. We've been in a somewhat of a downtrend, very, very conservative view of the markets. This is a weekly continuous corn futures contract, always looking at the very lead contract. And for sure, we back in October of last year, the lead contract, October 22, got up to 706.5, about 586 and a quarter here of late. And the thing that I note also, you see the relative strength index, about 35 and 50 as a break even. If 70 would be positive, so we're in 30 is pretty bearish. So we've just been drifting somewhat lower. The thing that I also note too is we've been drifting lower without a lot of change, nothing to shake the market up. Look at this bottom line, the standard deviation, kind of a measure of volatility in the market. Normally we're in May, coming into June, July, and crop production news would, if there is some that comes along, you'd bring volatility into the market. Mark, I'm really curious. I'll be really curious to see when we have another one of these next month to see if that volatility number stays low. And if it doesn't, it's probably associated with higher prices. So something to watch going forward. You can see here the DEES contract, and just to put a few markers down as we talk about in terms of where that trend has been. Again, we generally we had, when we broke below 540, let's see, go back to lowest, as low as it had been for a bit back in July of last year, and had gotten up here lately to about 575, 578, but closed 508 and 3/4 of late. So without question, the downtrend in the market not really doing any favors to meeting the price goals that we had for those plans going on. So in a situation like that, you're looking at probably what the calendar makes you do more than attaining long-term goals. I would say that again, that on Friday, the USDA came out with their May crop production for mainly talking about wheat and WASDE report, and they did include their first set of numbers again after the Outlook conference, first set of numbers for the next crop year for new crop 2023-24, and it's always good to see what the futures are saying and see what the USDA said. So the USDA came out and said, well, for the current marketing year that we're in, that'll end August 31st, they're projected about 660, and using the futures and basis numbers that I use anyway, you match up pretty well with that. You had futures looking at about 643 here the as a U.S. price for the marketing year, the current marketing year. For the next marketing year, the USDA came out at 480. The futures, somewhat, at least by my calculations, somewhat more optimistic, about 550. So there's a story behind that 480. And you can see it here. That this is the corn supply demand balance sheet that came out, and they plugged in 181.5 bushels per acre, and that's a solid trend line yield going back 20, 30 years, projects out to 181.5 this year. And if you do that, you end up with a corn crop of 15.265, basically 15.3 billion, which is about 1.5 billion greater than we've just had. And if you run that through their balance sheet, supply demand balance sheet, you end up with the ending stocks over 2 billion. This where we're at right now is about 1.4, and stocks to use from 10.3 and this year up to 15.3. And yeah, if you plug that in and see where that number takes you, we'll get 15. If we get that type of a yield, record high yield, actually a record high yield by 4 bushels per acre, you end up with something below $5 for a price. So I wanted to also present some alternative scenarios to consider. That if you figure for the 2 columns on the right, it's my own estimate. I think there's about a 40% chance of the USDA being right, and to present an alternative viewpoint, about 60% chance of something less than that for yield. And you can see if you're 177, we've never reached that number, but we've almost reached it. Then you're at about 14.8, 14.9 billion bushels. Ending stocks, by the time you work through the supply demand balance sheet, pretty consistent all the way through, except for the production numbers. You're looking at about 1.8 billion, and you're coming somewhat closer to where the futures are at, about 550, as opposed to that 480. So, Mark, that'll be the battle this summer. What is that yield? If we're at 550, let's say we're 70 cents higher, what does that do to our marketing strategies?
Well, I'm sorry, where did you say price is going to go up to?
If they go, it's about 70 cents higher than where they're at right now.
Well, that'll get us up to that 570, 580, 580 area again.
Okay. Sorry, I put you on the spot like that, but
no. Well, but bottom line is, if it does that, then I'd argue that's a great place to be making some of these catch-up sales.
Right. And that again, that narrative argument, that narrative bit of uncertainty about what will be the size of this year's crop, that's what's going to play out. I think that the market's pretty well digesting with rain right now and nothing imminent right in front of them. They're probably thinking more of the USDA number, but that's the issue that'll have to be dealt with this in coming months. And you can see there's the 177 off to the right, and again, we've come at 176.6, 176.4, 176.7. Haven't got to 77 yet, so I at least want to lay that question out there, and for those of you watching, to know that there's uncertainty in with regard to that USDA forecast, and we're just gonna have to see how it works out. And again, there's a difference between if you look off here to the right, the difference in the amount of production and the 40-60% rating, and you can see how that ends up affecting percent stocks to use and prices. So stay tuned. There are things to be dealt with here this summer. I would note that with USDA's projected with their 181 bushels, 101.5 bushels per acre basically ends up and makes the charts look like this. We're going from 10-11% stocks to use back down to 14-15%. And when we got down there before, we were at 350. Well, we've had inflation since that time, and so you got that situation as opposed to this alternative view of 177, which would still be a record, and you're more in the middle. So I guess just be aware that question has to be answered. On the world side, I'm looking at in the handout you've got. There are other slides I'm skipping over in the interest of time. But for corn, look at the world less China, and look at those projections. Then that projected new crop situation of 2023-24, which you have to remember is the thing that's confusing to keep track of, particularly for folks that may not be that attuned and watching the markets closely. And that might be some of the speculative folks that I'm digging myself a hole. Let's just go on. The point is that the 2022-23 marketing year includes this year's South American crop, and the 23-24 would include next year's South American crop. 22-23 so anyway, you got some issues at hand. We won't be planting the corn crop that goes into the 23-24 marketing year until this fall, until October, November, December. So you've got a lot betting on the come. And so the tight stocks year of 92 million metric tons for old crop 2022-23, we're at 10.6% stocks to use. Plug in an optimistic view, you're at 12% with pretty strong South American production coming next year. So still, I understand where the markets are at and how we got this place and the price levels that we're seeing, $550, something like that. But the point is that if I guess El Nino comes through, we start to get large crops, then you begin the process of rebuilding these stocks. And that's what takes prices consistently lower. Right now, we're looking at the possibility of that happening year after year. And you can see that, again, that when you look at, my good friend Guy Allen, who's on this, you can tell the difference between, again, we just keep pointing this out, the difference between China's stocks and the world less China, and you see just the magnitude of the estimated stocks in China. But the point being that if we're focusing on the world less China ending stocks, you're starting to see if that there's both the possibility of prices moving higher and something to keep track of in that, and ask yourself, have we turned the corner to now to where we'll start to rebuild stocks? You can see it on this number here from 10.7, 10.9, 10.1 up to 12.1. If that comes about, then that would be moderate to somewhat more bearish for prices. So just be thoughtful of where this thing is going. And you see the Argentina numbers. And so this points it out well. This year's crop in Argentina projected at 37 million metric tons, likely that'll come down even more from what we hear in country. It's a matter of, it's not where the USDA is at right now, it's where they're going in terms of that number. You see their exports are way down, et cetera. But then, and that's in the 22-23 market year. It's the next one what they're anticipating a rebound in. And Brazil, you can see the 130 million metric ton number that's weighing on the corn market right now. That's 22-23. They're projecting almost as big next year in 23-24. I remember information coming in the last few months that Brazilian corn crop is planted late, and that we had concerns about at the tail end of it, of how dry weather would come and affect that. There's not much concern about that being voiced right now in the market. I just hold that out there as something to still keep watch of in the coming months. And Ukraine, the challenge of the hard reality of Ukrainian production being a really affected really shows up here. You got 22-23, then 23-24 next year, and it just keeps cascading lower. And China has been, what Ukraine has been able to export, I think China's been a major buyer, and you can see some of their trends there as well. I did want to put up grain sorghum market scenarios and just state that some of the same risk uncertainty that affects the U.S. overall would affect grain sorghum. Here we've had rains in some of the major grain sorghum areas, and the yield that was put up there, 69.2, still that could come out fine. We still have June, July, August, September to go. We'll hope we get great moisture through there, but if not, there seems to me to be still significant risk of lower yields, lower production, and the possibility of grain sorghum prices moving higher. Grain sorghum, of course, is part of the feed grain complex. It really can't move on its own without arbitrage between corn and sorghum in some of these Western Corn Belt areas. So what the USDA has, they've projected a strong recovery in exports. And whether that'll happen or not, we'll just have to wait and see. This year, its projection is about 210 million bushels, and that to me is, by the time we get to the end of this marketing year, it'll be challenging to reach that. So if there's anything that's weak here, it's that export number. Pardon me, for the on the grain sorghum balance sheet. Let's take a look at soybeans. Try to follow the same pattern here of thought to be consistent. You can see the weekly chart. Again, very similar, not quite as long term, but very similar downtrend as for corn. Note again, RSI below 50%, about 39, a little stronger than corn, but not much. The same general lack of volatility. So again, stay tuned right now. I guess that'll be a weather dependent issue. I think that the large soybean crop came out of South America, certainly it's coming out of Brazil, certainly affecting this. Note here are the trends in this is the November contract, new crop contract mark. Our price, our futures price goals are probably much higher than this 12.23 3/4 that we pulled off of Friday's closes. Note the weekly RSI down to 25. So again, large crop coming out of Brazil, kind of outhorsing the losses out of Argentina to the degree that South America overall generally is higher, and you see this type of situation.
Hey, Dan.
Yeah.
Are you more bearish on this than you would be maybe relative to corn? I mean, do you think we have a shot at getting that thing back up to 13.20? For like I said, the average, our composite cost of production estimate was $12. If we can get it there back up to 13.20, hey, we're making some money. Even obviously soybean basis is much wider here in Kansas, but I mean, you're covering your cost. When we can do that, you're basically break even at that 12.80. What are our odds of getting futures back up to those levels?
If we only look at Brazil, you'd say, gosh, not much, but it's Brazil and Argentina. And for as much as we gain in Brazil, we're losing as much or more in Argentina as those reports keep going on. And we lose it at about 3 or 4 million metric tons a shot. So I guess they hire ag economists to be hand wringers. So I've not fully bought in on in my own thinking of in terms of where the soybean market is going in the short run, because I just don't know that we've fully accounted in our thinking, in our psyche, the major losses in Brazil, in Argentina that are occurring. That's so that to me that will supply some support. What will happen in short run is that when Brazil's soybean crop is fully out, when we're shipping it, it'll be weakness in the U.S. market. When that stops, then the gap normally filled by Argentina isn't there to be filled. Then where does that leave us? That could give us some support later on in the summer, in my thinking. And note, again, USDA's situation with their projection for current marketing year ending August 31st, 14.20. The futures are saying about 14.10. So that's about as good as you're going to get in terms of matching up. Interesting that for new crop bids, futures just slightly more optimistic than the than the USDA's projection for US price, 12.10 by the USDA, 12.34. But one thing I note, and you saw this on the corn as well, we get a projection, but you see the new crop futures, they're flat. You know, you get out, they're not showing much seasonality, and you can see the broader purplish line. That's the normal, at least Kansas soybean cash price trend following the general markets in the U.S. So it seems like the futures are pretty front loaded in terms of their attention, and they kind of base off of that. So if anything, if there's any seasonality shown coming into next year, then that would probably raise that price, and you're just not seeing that seasonality being reflected right now in the futures for new crop 23-24. And here's a supply demand balance sheet. And again, you can see if this pointer, you can see that 52 bushels per acre as a U.S. Yield. We were 49.5 this last year, puts us at about 4.5 billion. Stocks use ratio 4.9 was, and now with what's projected by the USDA is 7.6. 14.20 price this year, 12.10 next year. And so I wanted to bring in some alternative scenarios. What if we don't get 52 and we get still a good crop of 50.5, and that's still a bushel higher than we had this last year, or 49, which is about the same? Will you start? If you don't, if those production cutbacks, so basically from 4.5 to 4.3, 4.4, 4.2 and a half, you end up with ending stocks closer to 200, below 200, if usage isn't rationed any, and so then you see prices stronger. But Mark, this is for next year. Yeah, this is the new crop 23-24. We may not see that until we'd see kind of I guess a synergy of old crop and new crop if it looks like, hey, we're not going to get 52, and as we get into the latter part of the summer. So here's 52. So 52, we've been here before. Unlike corn, 51 U.S. yield in 2020-21, 51.7. 52 would be the highest we've ever had, but we're a little more comfortable in talking about that. You can see what it would do to production, 4.5 again billion bushels, and this is the USDA's perspective from 14.20 down to 12.10. This would be if you add the perspective. If you add on the right the low, get just modestly lower production, 4.6%, 14.40 by as I look at models and look at pricing relationships, 14.40. If we get down to 49, 15.50. So Mark, I hear what we're saying in terms of being conservative on beans. As long as Brazilian beans are coming to port, we probably won't see much of this. But if Brazilian beans get towards the end of their port movement, and we have any crop problems, then there's potential on the backside of the summer for some higher prices. What are your thoughts on that?
Oops, sorry, I sure would agree. I sure would agree that we could see it. I guess the concern, and I guess I'd love to hear your thoughts on that. You know, we're running behind a little bit. You know, you mentioned planting rates in some of those northern states, North Dakota especially, right? They're hardly started at all. We'll see what progress was last week, but they're probably not going to see much. I mean, but they're small players. I mean, well, the fact,
yeah.
I guess, how are you weighing out the fact that the Iowa and the Illinois crop are going in pretty good, aren't they? I mean, they're ahead of schedule, pretty good conditions, getting some rainfall. Indiana's on target. You know, I guess, is that going to offset problems in North Dakota?
Well, that's a good question. And when we talk about average U.S. yields, you know, 200 thereabouts, 190 195, 200, not a problem in those 3I states. But as these crops have expanded acreage out into other areas, it's problems on the fringes that bring the U.S. average yield down to the place where we say, gosh, 181.5 U.S. average is a little bit high. That's for corn. For beans, a pretty similar situation, although we haven't had as many soybeans in the West in general. So you asked me a straightforward question. I guess I'm dancing around it. I think it's a overall blended average. The problems in the north in the northern states come into play for is that 10, 15 percent. It's an increasing percent, or at least it was in North Dakota, and affect overall yields and bring them down. So it's I guess my view is it's a blended weighted average in terms of where we go, and yeah, right now we're going in fine in some of those areas, but there are other areas that still have questions. So.
Hey, one other thing here, the report came out in Kansas. We're abandoning, and I sure would agree with it, 1.5 million acres. We're starting to get some rain. How many acres are going to get put into maybe some feed grains, maybe not corn, but maybe milo? And again, obviously that's not going to swing things in a major way nationally, but it can make a difference short, or at least in Kansas and locally. But also you've got some of the same stuff going on in Texas and on the other side in Colorado. So there was a pretty significant bunch of, because I just looked at, 1.5 million acres of Kansas wheat. Well, I think we're seeing the same things a little bit in Oklahoma, at least in the west part, in Texas maybe a little bit.
Yeah, it'll be worth watching for sure. I wouldn't doubt that if we caught 2 or 3 inches of rain and we feel a lot more optimistic about going forth. Is that corn? Is that sorghum? I'm not sure. It could be an opportunity for either one of those crops. Sorghum, if it costs a little bit less to put in some cases in those areas, we might see some sorghum increase. And as we'd seen earlier, cash prices for sorghum forward bids are all still pretty good. Why don't we go forth? You're asking me tough questions. I need to move on. Gosh, sorry, Mark. I'm just giving you a hard time, but to try to get close to our done time. So you can see, you really see the estimate in the 10-year low for soybean production, and in on the world side, 65 million metric tons, 10-year low, 25-26% stocks to use, planning on a big crop next year. So there's, if those thoughts next year, particularly in South America, come through, and if we have a large crop in the United States, then yeah, we'll have switched the market from conversations aiming at dealing with tight stocks to suddenly, hey, we're rebuilding. And so there is that risk in the soybean market. And if that's the case, then forward pricing right now to protect against a bearish harvest would be something to look at. And just when you note Argentina and Brazil, the same trends we've been talking about, those are 22, 23, where the situations are, they're anticipating strong recovery, particularly and strong recovery in Brazil, growth in Argentina, strong recovery in Argentina, growth in Brazil. Let's take a look at wheat markets in a little bit of time we got left. Note that the strength that we've seen of late, from the lows we'd had in the last 2 or 3 weeks. Again, we're basically getting back to where we were and just a little bit above the place where we had been about 3 months ago. Still a ways to go. And note I think this is July futures, new crop futures, I believe, as my top of my screen gets cut off some. But note, we're coming back to we closed 877 still within our recent trading range, but the top end at 9 was showing, moving to the higher side. The last time I looked, we were up 20-30 cents from there. So some optimism now. And we did note on the RSI for that contract, we are above 50, more like 60 or so, and that's pretty rare occurrence for us of late. USDA projected current price of in this current market year 877, for next year 848. Excuse me, that's what the futures are saying. The USDA was projecting $8.85 again for current, and $8 for the coming marketing year. So you do have it's not enough to stand on a podium and scream about, but there does seem to be some differential in the expectations from the futures and the cash and the USDA projections. Here's that USDA balance sheet. Note that the production numbers just about the same, and ending stocks down some. 598 was already tight, 556 even tighter. Tightening of stocks to use, even with a little bit tighter stocks to use based on world situations, for a conservative price of $8 as opposed to, for this coming market year, as opposed to $8.85. So took the USDA projection of 44.7 and thought, overall, there's some good places in the U.S. for production, soft red areas, no doubt, but having problems in this hard red spring. We've got our problems down here in a hard red winter, and started looking at the impact of lower yield projections going from 44.7 to 43, 41.5 to 40, keeping the usage just about the same until basically that third scenario where you have to start rationing exports some, even at their low levels, and ending up with if 30% stocks to use, the USDA's latest projections tight, you're just tightening things up, and you're going from $8 to $8.25 to $8.60 to $9.05, and again, you're heading in the direction of where the futures are, which is a little bit higher than the USDA's thoughts. And this year, Mark is consistent exactly with what you'd said in terms of low harvested acres, a lot of abandonment, being torn up, et cetera, in the U.S. overall, and 74.4% harvested to planted, the lowest in years. And you can see that USDA's projection of 44.7, KSU projection of 30% probability of 43, and that would be below where we've been since at least 2010, but we have been down near that. Projection, USDA thoughts. There's that $8.85 for this year, $8 for next year, and here you have these other K-State numbers with lesser yields, and basically everything's being at least moderately to more strongly higher than the USDA's $8 projection. And tight ending stocks to use, a 16-year low right now for world less China stocks to use numbers, and that's with next year included. So I'm going to come back and talk on that, Mark, and you can see that the tightness of the wheat markets, of the stocks to use from the world less China and of the world. So the wheat market, just in final thoughts here, it's a quandary because these were tight worldwide. We're affected in Kansas because we're in the U.S. with the high U.S. dollar really limiting our export potential, but yet the world numbers are as tight as they've been for years at 19.4, tightest since back in 2007, 2008, which was a strong year market wise. So and now we've got problems with the hard red spring and hard red winter numbers, and yet the markets are I wouldn't say bearish, but they're sort of medium, sort of normalish, sort of not really aware of things. My own opinion is that these tight underlying fundamentals, as long as we don't have a shock that forces the market to have to deal with these, we're pretty content to go pretty much sideways. But in my thinking, there's risk out here, and fair amount of risk that if that calm demeanor of not being worried about a major crisis continues, well, then again, we won't see something higher, but there's the margin to get to that is pretty narrow. So Mark, I'll take your chastisement on my over bullishness, but I just don't see the fundamentals are tight. and yet the markets are pretty much sideways. I just think as they keep going that way, that there's more risk out there than they're accounting for at the moment. Comment, Mark, what do you think on that?
Oh no, I'm with you 100%. I'm kind of bullish. Oh, I don't know if I'm bullish, I guess, but yeah, no, I guess my concern is that, when we think about what do I do with my wheat?
Yeah, what do you do with it? Right.
Basis is very, very strong now. And I just look at here, March futures are at 859. So, I mean, literally it's a positive basis, March basis. So again, if I'm going to put my wheat in my bin, or I'm going to haul it to the elevator and not sell it, I'm going, that basis is going to hurt me. Right.
Yeah.
Typically, even in March, if we say, well, it's going to stay and be zero basis then, right? So a strong basis, that still means it's going to, versus March, basis is going to deteriorate. And that makes storage tough, but it does kind of favor, trying to re-own it somehow. And so I think people need to sharpen their pencils and take a look at that, don't you think? Because again, buying that call or something like that would allow you to not have to fight the basis issue or the storage issue, let you focus on your feed grains and oil seeds. But by re-owning it, you might have some opportunity to take advantage of this tightness. Would that be a fair thing?
Yes, and I go a step further. If you really if you take, in essence, you look at this, if you're optimistic about the wheat market, you're taking a contrarian view to what the market has been doing of late, and that can be viewed almost as a speculative move. So we're not telling people to be speculators on this thing, but it just, in my thinking, there's uncertainty that's not necessarily, that may not be necessarily being dealt with in the markets and in the wheat markets, as just given how tight things are. So that's my thought anyway. So, okay, here we go. And just want to show you the Ukraine situation, Russia. Just a side note: if Antonina was with us, Antonina Baraka, she'd no doubt have comments. But the highest Russian production up until up through 2020-21 was 85 million metric tons. They got 22-23, they got about 6.6 million metric tons more than they'd ever produced. Projection next year back down to 81. So in these areas taken over, a lot of thoughts of Russian that wheat was shipped out under Russian auspices as opposed to elsewhere. And you look at those numbers, and it seems like it may be the case. So I guess are there any other questions? Let me stop to share and try to take a look at the chat to see if there's anything.
There was one from earlier, Dan. How will the Fed's failure to extend the debt ceiling impact prices, or conversely, how will an extension increase in the debt ceiling impact grain prices? And Guy, yeah, go ahead.
I would. Okay, I have a thought on that. Guy, do you have something you'd like to add to that?
Go ahead, Dan, you first.
Well, thank you. Well, my first thought is the Fed's action affects interest rates, and if interest rates are raised, and I think they've taken a little bit of a pause in that, then that's generally at least not negative, further negative for the overall economy. So I see commodities following the impact on the stock market to some degree. So what the Fed's actions affect interest rates, affect the economy bleeds over into commodities, and the Fed raises interest rates as Mark was talking about. Interest rates are a major part of storage and handling inventories and grains. So I tend to think that higher interest rates tend to hurt commodities and vice versa, and that's the indirect effect. The direct effect is it hurts our exports, and we just suffered the most in that, I think, just because the world has so many other options in terms of wheat production. Does that,
Well, Dan,
colleagues?
I think she was asking about the potential debt default here around the 1st of June.
Oh,
that's looming.
debt default. Okay, sorry.
So how does the Fed's failure, the government's failure to extend the debt ceiling impact prices?
Well, I hope it's not. I hope you wouldn't be looking at something like 2008 during the fall when we froze up financial markets and we had a lot of panic. You know, the ag commodities and so many other parts of the economy suffered at that time. So if the debt ceiling isn't dealt with, then you put fear and risk into the economy, and that, and in my thinking, you'd impact the decisions of businesses. Do they, in a risky situation, do they want to carry inventories? If they're not, if ethanol plants, et cetera, go more hand to mouth, then you're taking support away from the grain markets, and at least that's my initial thought.
I just might add 2 cents in, Dan. I
Sure.
look, agree with everything you said. I just think they're playing a game of chicken. They're not going to default. They're going to extend it. My overall concern is I don't see them reining in the spending. So that continues to be quite inflationary, i.e. the Fed's going to have to continue to raise interest rates to stay ahead of that. And that's the inflationary side of it makes me bullish commodity prices. But gee, we're starting to see fairly significant removal of demand out there at these higher prices. And look, we've seen it definitely in corn. I think we're starting to see it in wheat, and the global community is pushing back in this whole dialogue on questioning the position of the US dollar as reserve currency if we can't manage our financials correctly. And so it just makes a very frustrating situation with a lot of uncertainty out there. But bottom line, I think it has to be supportive of commodity prices, but I don't know if it's supportive of the value of the dollar. So
Yeah,
it's not a good situation.
it's pretty easy to go to get talking political issues on that, and with that, we probably better move to NAS issues. If I can share my screen again, Rich, I have something that can address that Southwest wheat deal. So if that's okay. Okay, excuse me here. So the question was, were the losses that we've been seen in Western Kansas Southwest in particular, are they factored in? So you see the planted acres, the US, that harvested acre figure is the same harvested acres. And when I've talked to the USDA folks earlier, they were using last year's harvested acres relative to planted as a guide for what they were going to do this year. So if that number is off, then the overall quantity would be still too high for Western Kansas. Note the yield for Kansas, 29, down 22% production, 191. So I think the answer to that question, a great question, is a balance of whatever areas of the state, and some more to the east, et cetera, eastern part that have good production, are they accounted for, and how many bushels are we talking about? And note that you can see this harvested versus planted acres figure come into play, and the ratio of winter wheat harvested to planted, 67.4 overall in the U.S. And here's our in the upper left, the planted acres challenge. They've already, if anything, Oklahoma is they're probably already showing their acreage cutbacks. I would wonder if we'll see more of that going forward out of Kansas. And then the yield, 29 bushel per acre estimate, and for Kansas, 23 for Oklahoma, 28 for Texas, so, and 30 for basically eastern Colorado. So is it all accounted for? Sometimes. Well, I guess if we look at it look at what NAS does, given what they have in hand. Their mantra is they take what they see in the field and they assume normal conditions going forward. And if there's a lot of possibility, 50% chance that number may get adjusted lower if we don't have normal situations, or if there's more abandonment coming in. And again, I think, yeah, if I didn't show this already, you can see the hard red winter wheat production number in that upper right-hand quadrant. Well, 514 million bushels, the lowest we've seen for a good while. And does the USDA fully account for the losses in Texas, Oklahoma, and Kansas yet? I don't know, but if it would not surprise me at all. And there's pretty strong possibility that number could keep getting ratcheted a little bit lower as acreage losses accumulate as going forward. And what Mark talked about earlier, if now we have moisture, we have pretty poor wheat, do we work with crop insurance, work with FSA to put grain sorghum into that, or corn or something like that? That could all come into play too. Mark, Guy, any thoughts on that?
I liked your answer. Again, we don't ever know for sure, but obviously, as you ran through those numbers, they did reflect a very sharp. I mean, 1.5 million acres are already being abandoned. I think it's like I don't know, I want to say like an 81% percent harvested. That's incredibly poor for Kansas. So they've taken into account. Now, again, that the question that Dan hit on that is it going to continue? And I don't know. I mean, we're starting to get some rain in a lot of places, sprinkles. Is that maintaining? And again, so do we, in those other places where we haven't tore it out yet, do we go ahead and do that now? Or did it improve enough that I go ahead and hang on to it? At this point, I wouldn't adjust my estimate for the state of Kansas, but I think probably these numbers are pretty close to where we're going to be, honestly.
And the thing to keep in mind, if you look at the back of USDA NAS and WASDE reports, they have a forecast error estimate, which they don't talk about much. So the number you see here is a midpoint, and the forecast error estimate a lot of times 5, 6, 7%. So we're still that they could make changes and we'd still be within the range of their forecast error. So it is as it is. Well, with that, we've run over 1 o'clock with discussion. Are there any other questions we should?
Dan, there's one down at the bottom. I'm not sure you got to the non-renewal of the Black Sea deal affecting the wheat market.
Yeah, I did not see that. Okay. Well, Guy, I'll answer this first off, and then if you want to hop in on this too, because I know you have your hand and focus in the international side. I think when we watched the wheat market over the last months, several months, it sort of viewed renewal or non-renewal of that as a foot on the gas pedal, as almost an opiate in terms of if when we've come down to the brinksmanship negotiations at the end and wondering if anything's going to happen, then when it finally does get people's attention, then it's optimistic for the markets, positive price wise. So the market has viewed it as very important that the flow of that grain continues to happen. Now you've got these other factors. So much grain has gone by rail from Ukraine, what they could get out, and kind of flooded neighboring countries by land, that the EU has had to come in and subsidize farmers in those countries just so it wouldn't just wreck their markets. So it's a conundrum, and we're at the mode now where we've cried wolf on this so long. I don't think people will actually react to it until it actually fails. But Guy, that's my thought. What do you think?
Yeah, look, I concur. Logistically, we've got last year's crop out and executed. So if they do shut it down, it's not going to provide a logistical issue immediately. I sort of anticipate it coming. It will put a bullish sentiment on the market. I think the more interesting point is the drop the USDA had in Ukrainian grain production. And I would actually suggest you could probably drop it more than that. I think it was by, what was it, by half, and exports by a third, or a quarter and a third.
It's like throwing darts at a target.
And I don't know if, will they get it planted, and two, will they get it fertilized, and then three, will they get it harvested? And then they got to get it out of the country. And I think, infrastructure wise, Antonina would be across this a bit more.
Yeah.
That infrastructure just continues to get tore up. So I think that's, adding significant tightness to the balance sheet, and the Black Sea as a source. So yeah, I think, look, we've got through this year's issue, and I sort of expect Russia to tighten that up, particularly as soon as we start to see some sort of movement on what they refer to as the spring initiative, which they anticipate in late May, maybe June, but we'll see. Nothing's really happening there yet.
Thank you, Guy.